Welcome to Two Quants and a Financial Planner, where we bridge the worlds of investing and financial planning to help investors achieve their long-term goals. Join Matt Ziegler, Jack Forehand, and me, Justin Carbonneau, as we cover a wide range of investing and planning topics that impact all of us and discuss how we can apply them in the real world to achieve the best outcomes in our financial lives.
So the two factors we're going to talk about today are very interesting to me because on one hand, they don't get as much love in the academic community as the main factors. So value and momentum definitely in the academic community and the practitioner community like I am, they're at the top. And these other factors are lower. But they also, investors like them a lot more in many ways than the other factors because they tend to be lower in volatility. They tend to relate to what people want to do, which is buying great businesses. So it's interesting, that dichotomy between, and we're going to talk about quality and low volatility today, but it's interesting that dichotomy between the way that people look at them in the academic community and the way that investors look at them in the real world.
I'm fascinated by this topic, possibly as a highly volatile individual, obviously.
Am I the low volatility on this and you're the high volatility on the podcast?
Yeah. I'm high vol, high beta. You're pure alpha, Jack. You're pure alpha.
Hopefully we're both quality though.
I like to think, excess returns is a quality endeavor. I think so. What I want to just talk about this for a second because I know we're going to talk about quality. We're talking about the quality factor and how it works in security selection, portfolio construction, all sorts of fun things like that. But I think it's actually really interesting because quality is one of those terms that it sits there over to the side of quantitative. It sits there over the side of these other things. It kind of feels like ESG and GMOs and it's like the organic food of the investment industry where it's like, well, what really does it mean? As soon as you start, it's like, well, do I eat anything that's inorganic? Would I ever buy something that is not quality at all and why? You start to raise these questions. So I looked into the etymology of the word. Are you familiar with the etymology of quality, Jack? I know you think about this stuff all the time. So the Latin qui, that's basically who, and then qualitat, qualitas, who of what kind. So the modern definition is the standard of something as measured against other things of a similar kind, the degree of excellence of something, or as the poet philosopher Talib Kweli once explained, his name is in the middle of equality. I think equality is actually useful here because that's the quality of state of two things being equal or the same, which sets up inequality or quality as we're defining it as a way to explain a difference relative, but in a different direction, in the direction or the orientation of excellence. So when we're talking about all these things, we're actually saying who or what in the orientation of excellence. That's kind of the scale that we're measuring things on. Understanding that anytime we say quality, we then also have to define the scale is kind of incredibly useful because it allows us to take all these various academic explanations, definitions, and otherwise, and start to go, great, quality, but now on what scale of excellence? That actually really helped me in understanding this literature better.
Yeah, the scale is important in investing too, because if you think about it, a lot of value portfolios will use quality, but what you're getting there, if you start with value and then you add quality, if you think about the overall scale of quality, you're not getting the highest quality companies in the world because once you've put the value on there, those companies aren't going to be cheap. So it's important to think about it too, from that perspective when you're an investor. You can invest in just the highest quality companies and you can not care about the valuation of them, or you can try to buy cheap companies, basically the Warren Buffett approach, try to buy high quality companies cheaply, in which case you're not going to get as much quality, but you're going to get some quality relative to the cheapest bucket, which is just the pure value stuff.
Yeah. So remembering that there's always a ruler present. Whenever somebody trots out the word quality, we have to ask, what's the ruler? Because the ruler is kind of setting the parameters for how we're defining it. Because to your point, if you put value first, you might slice off a bunch of the highest quality stuff. And likewise, and we'll talk about this, you could put the crappiest of crap, but you could take the crappiest of crap ruler and say, what's the highest quality of the crappiest of crap?
Yeah, and it's interesting because the top of the ruler is not necessarily always the best. I mean, in terms of the quality factor, it is. And we'll talk about that later. The top decile of quality outperforms as you work your way down. But if you start with value and you add quality, you may end up with a better portfolio, even though you're further down the quality ruler because you're adding something else that also adds value to your portfolio along with the quality.
Yeah. It's a fascinating tool. It's a fascinating framework for understanding things. And this is, I'll just put this up front. This is one of those things where understanding the lowest of low quality, the crappiest of crap, Many times this works as a really great exclusionary screen. It helps you take stuff where you're like, I just don't even want to fess with this thing that either I can't understand, has a bunch of red flags in it, or whatever else, and allows you to kind of filter stuff out almost more valuably than what you keep in.
Yeah, so let's go to the definition. And this is interesting because this is kind of a you know it when you see it factor to some degree. Like if you think about a high quality company, like a lot of the things you think about is probably as we work our way down to the academic definition is probably what you're going to see. But if I was just running my own business down the street, like what would I want to see? I'd want the business probably to be profitable. I'd probably want the least variability I could have in my results. If my earnings were pretty consistent, that would be better than if they're all over the place. I'd probably want to have a decent balance sheet. I'd want to have some cash on there. I'd want to have not too much debt. And if you think about it, as we carry down to the definition of quality, I mean, that's what this is. This is trying to find companies that have those types of characteristics. And as we work in the quality factor, we're just doing it quantitatively to try to identify those things.
This quantitative definition, and again, back to like this ruler idea, is I think of it a lot like, it's a lot like food. You have junk food on one extreme, and then you have really healthy food on the other extreme. And you can start to kind of understand where it's just like, all right, I get why the potato chip is not as value or relevant to me in nutritional value as, I don't know, the piece of broccoli or whatever. And there's sweet spots in how you balance this stuff and put it together in a portfolio where we can talk about the things one-off as what the potato chip is or what the piece of broccoli is, but then we can also talk about what does a balanced diet looks like. This language, as much as it's, I know it when I see it, is also really useful in examining the little pieces and then the construct of the whole.
Yeah, so I just want to read the AQR definition quick because I think it's good. So AQR has a great paper on quality that you can find on their website by Cliff Asness and some other people there. But their definition of quality was AQR capital management is defined the factor QMJ, quality minus junk. And it's important to remember with factors, it's always long the best, short the worst. So that's what quality minus junk is. Junk is the worst companies. To be companies with the following traits: low earnings volatility, high margins, high asset turnover, indicating efficient use of assets, low financial leverage, low operating leverage, indicating a strong balance sheet and low macroeconomic risk, and low stock-specific risk, volatility that's unexplained by macroeconomic activity. So Matt, give me this business. Like, I love this business. I want the business that has all of these things.
You're describing, the Excess Returns YouTube channel, I think, to the T.
You are, yeah. The business behind the podcast is all those things.
Hey, low financial.
Potentially, it's none of those things, actually, if you think about it. But we'll skip that part of it.
Well, but it's again, like understanding it as quality minus junk. And if you think about it, it's also useful. You have to play the ruler out over time. That's kind of this idea of being, if I can repeatedly be short the worst and long the best, back to diet terms. This explains why if you go full supersize me and you just eat McDonald's, or if you only eat the potato chips and you never eat the broccoli, you're going to run into a different type of health problem than if you only eat the broccoli and if you always avoid the McDonald's and the potato chips. So it's intuitive, but it's really important to, I think, see it framed up in that way as AQR did.
Another thing to keep in mind here is that these are not always the same companies over time. Like, what is a quality company today may not be a quality company 3 years from now. There's certainly some consistency. And there's some companies that have just been quality companies for a really, really long time, but there's others that move in and out. And so it's, I think people, when they have a picture of a quality company, think about this idea of consistency. And there is consistency in their metrics when they are a high quality company, but just because you're a high quality company now doesn't mean you'll be a high quality company forever.
Yeah, this is a snapshot in time. Every point along the way, it's a snapshot on all those metrics, on low earnings volatility, on high margins, on high asset turnover. All those things like low earnings volatility can very quickly, you run into a pandemic and things happen. An interest rate environment shifts and things happen. These are not static reports. These are all dynamic reports and therefore feed into how a company is viewed over any time period.
So another thing you'll see sometimes, in the places like AQR and us typically don't use this, but you will see dividend growth used sometimes as a quality metric, or consistency of dividends over time, or something like that. I don't think it's the greatest factor. And sometimes it can be a problem actually from a quality standpoint, because a lot of times companies that get on these lists of like the consistent dividend payers for like 25 years will basically do anything to not stop, to keep paying the dividend. And like in some sort of financial crisis, they'll be like laying off their employees to pay the dividend or whatever. So it can be a little bit dangerous, but you will see this. You will see dividends used by some people too as a measure of quality.
Yeah, and that's where, and there's a bunch of people with a bunch of great work on this. Dividend growth alone is a dangerous indicator or even dividend stability alone, because if you're not also incorporating the balance sheet against that cash flow statement, one of the things we saw a lot of was in some of the oil companies, and I'm specifically thinking of a certain overseas oil company, where they just kept borrowing more and more money. So in a low interest rate world, it's like, well, just keep supporting the dividend and raising it, but they just kept on taking on more and more and more and more debt. And all of a sudden you start to have the question of, well, if the interest rates change and we have to roll over this debt, how are we going to cover the interest service and sustain the dividend? And we've seen that play out in telecoms and a number of other places too. So back to that point you made earlier of these are just a snapshot of one point in time. You got to keep taking pictures and make a movie out of this to fully understand it and avoid those single variables that can be really dangerous.
So just a couple other things we should mention before we move on to the next thing is we should mention Joseph Piotroski's work. And by the way, I believe it is Joseph Piotroski, and I mispronounced it as Piotroski for like 20 years.
Congratulations.
So someone can correct me if I'm wrong, but I believe it is Piotroski is the way I should have been pronouncing it for the 20 years that I was mispronouncing it on this podcast. So I apologize if Joseph listens, which I doubt he does. I will apologize to him for my mispronunciation of his name. But anyway, he did this work around F-score, which is a paper that's definitely 20 years old plus. And it was an interesting paper because one of the problems with value investing is you get these crappy companies, you get these value traps. And so he did a lot of research around what could be the criteria I could use to try to limit these value traps. And he came up with this F-score, which is a bunch of different things. I'll read them: return on assets, change in return on assets, cash flow from operations, cash compared to net income, change in long-term debt to assets, change in current ratio, change in shares outstanding, change in gross margin, and change in asset turnover. So he's looking at a lot of changes. He's basically saying, are things getting better for this company? And can I limit some of these value traps in the value universe by using what is a quality metric? I mean, that's effectively what F-score is. It's a different thing, but it's a metric of quality that tries to eliminate these value traps from a value portfolio.
It's also really interesting in talking to people like Jim O'Shaughnessy or Mike Green or anybody who helped take the old CompuStat data and basically in the 90s and with the advent of computing, start to like turn these metrics into things that you could actually use for markets portfolios. And it starts off with a lot of these things where you're just trying to understand if I were to avoid the value trap, in particular, if I'm trying to do a leverage buyout or if I'm going to step in and take a public company private or absorb it into another public company or something else. Think about it, if I'm buying a company out in full, if I'm going full old school Buffett on this thing, these are the types of things I really want to be aware of, because it might look like a great value. It might look like a great deal, but it's got all these red flags. And the Piotroski scores, Altman Z, some of these other stuff that come into just ways we can cut off that left tail of the junkiest of junk, that can be really, really valuable to just make sure those red flags get raised. Where it gets problematic is as you play that stuff forward and people start to treat it as an arbitrage and go like, oh, I have something trading at 10 times cash flow and something trading at 2 times cash flow. And all I have to do is short the 10 times and get long the 2 times and I can close this gap for free. And that's not really an arbitrage. And that's kind of the bastardization of this problem. But understanding this, at least in concept of ways to raise these flags and then how you apply it to not just your portfolio and your security selection approach, but like, what's the end result you're trying to get out of this stuff? I raise this because for some of these, they're really interesting academic details. But if you're not taking the company private, or if you're not trying to understand in portfolio construction, the pairing of these things, they're not always as useful as they are interesting.
The other thing I'll just say before we move on from Piotroski is a lot of times with academic research, you can look at papers as a whole, or you can also take a component of the paper and you can really use it in a different way. And so one of the problems with, if you run a screen, and we do run one on Validea based on Piotroski, and you look at it over the past, 10, 20, whatever period you want to look at, it's a catastrophe. It's obviously a deep value portfolio. It's been a period where deep value has not worked at all. But what's interesting about that is that doesn't necessarily mean there's not value. I mean, and again, first, that may come completely back and we may see a huge run in those types of stocks. But one of the things we found is if you carve out the F-score part of it, because what he did in his paper is he used for his valuation metric what all the academics use for their valuation metric, which is price to book. So he looked at the cheapest price to book stocks and then applied this F-score. Well, if you look at the cheapest stocks using a value composite and you apply the F-score, you end up with a very different outcome. And so that's a way. This F score may still very well be a good quality metric to use, but you have to sort of shift the value part of it to get, as much value out of it. Because a lot of us in the world I'm in are not big believers in the price to book, especially not as the one metric you're using. If we're using it, in together with a bunch of other metrics. So that's an example of the F score may still be valuable, even though if you combine it with price to book, your results in the past 10, 20 years have been really bad. And with any value strategy, your results haven't been great in the past 10, 20 years. But it's just an interesting thing to think. You can sometimes take something like this and use it in a different way.
It's part of why I was really excited when I read the etymology, because that who of what kind, this idea of saying like who, and then how are we defining it? How are we using it? What's the ruler and what's the parameter of the rulers? It actually makes all the difference in something like this, because something that worked 20 odd years ago in an academic regression, a little bit of updating and tweaking for the way the world thinks about itself today can go a long way in saying, oh, no, there's actual merit here. I love that story.
Let's move to low volatility. Low volatility is actually, this will be a short one. It's an easy thing to define. I mean, it's obviously stocks that exhibit low levels of volatility. You'll see two standard metrics used a lot: standard deviation, which is just the volatility of the stock on its own; beta, which thinks about it more in the context of the portfolio, how it's related to other stocks in the market as a whole. So those are the two things you'll see. I mean, you'll see some people use one, you'll see some people use the other. You'll see some people, which we do on our factor report on Validea, use a composite of both of them. But the idea is I'm trying to get stocks that are less volatile than the market. And we'll talk about why in a minute. But the great thing about low volatility stocks is you would expect, if theory is correct, you would expect if I'm buying the stocks that are the least volatile, I should get a lower return because I'm taking lower risk. But that's not the way it works in the real world. In the real world, the cheapest, the lowest volatility stocks, the bottom decile, give you something in the range of a similar return to the market with significantly less volatility than the market. So you are getting kind of a free lunch with these types of stocks. And the stocks in the highest volatility bucket are a catastrophe. They're way more volatile than the market. They don't have better returns. This whole thing we saw in the beginning, this idea of like, if you measure risk in this way, that you're just going to get better returns as the risk goes up, has just been invalidated. It's not true. It's not the way things work in the real world.
It's a statistics puzzle. It's a way to look at it just from the math side of it. And that also makes it really interesting, because if I'm really narrowing in on which specific rulers I'm going to use in a specific instance, you're just controlling for variance. Like, that's what you're doing here. You're picking which things, and then you're going, what's the variance around on this, and give me the least amount of variance on this, which, hey, it can make a world of difference when you're rolling that snowball over and over and over and over again, and you have a good consistent snow that's going to pack well. What you don't want to do is have that one little tiny flaky snowball and, be chasing it down the middle of the road where they've already plowed and picking up salt and a bunch of other things. High vol snowball rolling, not a good activity.
Not a good idea.
Far. Yeah. I've tried.
But going back to like the dichotomy thing I talked about at the beginning, low vol is interesting from that perspective, because on one hand, like investors, it's like momentum to some degree. Investors don't understand why it works. Like, if I'm buying stocks that are less volatile in the market, why should I get a better return? And even the professionals and the academics have some trouble explaining why low volatility works. But investors love it in their portfolios. Like, you build a low vol portfolio, if you're getting the similar return with less volatility, that's fantastic to experience on a regular basis. So in a lot of ways, they don't really care why it works. But if it is working, that's great. Now, the one downside is, like any factor, it has its periods where it's out of favor. And so just because it's less volatile than the market doesn't mean it doesn't diverge from the market a lot. So it doesn't mean you can have a period where a certain other type of stock is really running in the market and you're underperforming a lot in your low volatility portfolio, even though you may be having less volatility in the market. So that second risk Jim O'Shaughnessy always talks about, which is the risk of underperformance, that can be a big risk with this, like all the other factors, but it is better on the pure volatility from a pure volatility standpoint.
My mind always goes to this expression that there's a difference between what the statistics say and what the statisticians do. And you got to remember that in a case like this. You got to be able to peel apart the data and just go like, okay, the statistics actually say this. But now if we actually want to go implement on this, if we want to actually do something about it, let's try. It's the, cancer doctor enjoying a cigarette out behind the hospital. Be aware of all these things.
So we'll just briefly touch on some of the academic research here. And I think the first thing we should talk about is I love talking about Larry Swedroe and Andy Birkin's criteria for what makes a good factor and applying this. And these do apply to all, these two factors both pass all these tests. But the criteria is the factor should be persistent. which means it should work over time. We're not going to use it because it's worked in the past 5 years or something like that. We should have a very long period of data that tells us this thing works. It should be pervasive. It should work, assuming it applies across asset classes. It should work across asset classes. It shouldn't just work in stocks. Like momentum's a good example of this. Momentum's been proved across a bunch of different asset classes. It doesn't just work in one. It should be robust. So if you define it in different ways, it still works. So quality, if quality only worked when it was like the variability of earnings, but it didn't work with profitability or some of the other things, like then it's not as good of a factor. You want to have a broad way to define it, and it should hold up using different definitions. And then intuitive, which may or may not be true anymore, but the idea at the beginning was these things there should be some logical reason it should make sense. And, we had Alejandro Lopez Lira and Andrew Chen on the podcast who are challenging that idea that maybe a lot of these factors that don't make sense are as good, if not better, than some of the ones that do. And that's something we'll research in the future, and because they have really strong evidence to support what they're doing. But in general, if you go back to the original factor framework, the idea that a factor should be intuitive is one that's always in there. You feel better if there's some economic reason or some reason why this thing should work.
And at least in the sense of quality, again, the directional orientation towards excellence compared to something else, the who and then what ruler, it's the purely intuitive, I know it when I see it thing that you talked about at the beginning is that's there. It's going to be persistent, it's going to be pervasive, and it's going to be robust, because if all you do is just make sure something is a steady compounder over time, or I'm reducing that downside of doing something that doesn't actually meet the purpose and potentially works against you, if you can persistently roll that snowball, then it will pervasively grow, and it's probably robust to 10 different definitions to do it. That's intuitive enough to get this general concept across.
Did you just work all the P's into one sentence? I think you might have.
I definitely did. Thank you, Larry Swedrow.
That's very, very impressive. So let's talk a little bit about why these things work, because they shouldn't, in theory. If we've talked a lot on the podcast about the reasons a factor works, you've got your risk-based explanation, you've got your behavioral explanation. Well, let's start with the first one, your risk-based explanation. Try to explain low volatility or quality. Like, I could sit here all day, you're going to have a hard time. Given that you can explain anything, you may be able to do it, but you'd probably be digging pretty deep to figure it out. I mean, these are not low volatility by definition. The stocks are less risky than the market. And quality, I mean, who's going to argue that like the highest quality companies with great balance sheet and consistent earnings and high profitability, that those companies are going to somehow be riskier than the market? It's very, very hard to do. So most people do not buy into the risk-based explanation with this, whereas like something like value, we do think that's a big part of it. With these two, we don't. So then how do we explain them? We've got to explain them with the behavioral explanation. So some sort of mispricing is going on that we can take advantage of as an investor and profit over the long term. So how do we do that? There's a lot of different ones. I won't go through all of them, but so for instance, with low volatility, there's this idea that a lot of investors don't have access to leverage. And so if they want to juice up their portfolios, they'll chase like the highest volatility stocks and they'll overprice those stocks. And therefore, by buying the low volatility, boring stocks, I've got an opportunity to make a profit. The same idea, like investors seek lottery stocks sometimes and overprice those. So that could be part of it. Overconfidence could be part of it. With quality, it could be like investors focus too much on the short term sometimes, so that they focus on these companies that are doing great things or whatever in the short term, and they underprice what long-term quality means. So that this whole consistent just grinding up, they underprice that over time. So there's a lot of explanations for it, but they're not as strong as value and momentum. Like when I was doing this in the value and momentum podcast we did, like I felt pretty strong about what I was saying. Like this is a really good, strong explanation. They're a little weaker here, and there's a little more disagreement about them.
Do you feel like with quality in particular, quality seems like one of those things that I know the statisticians would argue that it's predictable, but it's one of those things that this truly feels like it works the best over time. It's like, it's really easy to look back and go like, oh, there's quality working. And it's really hard to say like McDonald's or whatever has this figured out forever and is going to keep following in these footsteps.
Yeah, that's right. It's a slow grind up over time. And, one of the other interesting things about quality is the reason people think it works is not why it works. People think it works because I'm buying these great quality businesses. And if you buy these great quality businesses over time, you're going to do well. The problem with that argument is the market knows that they're great quality businesses. And so you've got to have, if you're dealing at least in the academic world, you've got to have some reason the market would misprice these things. It's great that they're great businesses, but the reality is a lot of great businesses are overpriced sometimes. So like in the academic world, we think about it very differently than we think about it the way a person would think about it. Because you or I are buying Apple or something, we're thinking, wow, that's a great quality business that's going to do really well over time. But the question I have to ask myself is, why is the market not pricing that future growth properly or that quality properly? And that's where the academic definition kind of differs from the way your average person would look at it.
It's kind of like value investors inventing GARP, right? It's like, I want growth, but I want it at a reasonable price. Oh, you mean value investing? No, I mean growth, but at a reasonable price, as opposed to an unreasonable price. And yeah, it's word salad in the end.
So one of the things I want to mention with both of these factors, because I mentioned at the beginning, they're not considered like the A-level factors. And I forget it. I think it might've been Birkin in Swedrow's book where they kind of classified the factors based on where they are, but like value and momentum are really considered your like A-level factors. And these are, for most people, are considered complements. So like most of the guys I know building factor portfolios are using value and momentum at a higher level than they're using these. They're certainly using these, but they're complements to that. And that's the important point to make here is these are great as secondary factors. They're great when they work with other factors. So yes, it's true that low volatility, gives you a similar return at lower volatility over time. But what's also true about it is if you couple it with value, if you couple it with momentum, you've got an even better portfolio. And Pim van Vliet's done a lot of work around this. Like the strategy we run on Validea based on Pim van Vliet uses this low volatility along with other factors. And you'll see a lot of people too that are kind of the Buffett type people with value, which is I want a cheap portfolio, but I want some degree of quality. And that works in a lot of different ways. Like some people are like our friend Wes Gray with QVAL, their quantitative value fund. They start with the value, they add the quality. They don't want to just buy the cheapest stocks. They're seeing an improvement in what they're doing by adding quality. Then you've got the Buffett type people that might say, I'm going to start with the quality and I'm going to add the value. I want the great businesses. I want them cheap. You can do it in different orders. I would argue the value approach first is probably the better approach just because value, I think, is a better factor than quality over time. And I'd rather have that be a bigger impact in my portfolio. But you see this in almost all, like, I don't see, you do see in some ETFs, you see no quality filters, but most of the stuff you see out there these days that's like a quality ETF has some degree of, that's a value ETF has some degree of quality implemented in it. So these factors work really, really well with other factors. And that's how you'll see them used in the real world a lot.
It's interesting too, because there's almost a reputational component for, at least for professional money management, of understanding quality, whether or not you're formally screening for it or not. Because this is also one of those things where you're less likely to be touching the live wire or like doing something that feels irresponsible if you have something in there that's doing it. Less likely to have a fraud, less likely to have something that's just like, I don't know, whatever deserves to get thrown out, the bathwater itself. Quality is like the ultimate wingman in this scenario where you're like, yeah, of course they're here with me. Because if you're out there doing this like solo with total ignorance of this and you miss some of this stuff, you can see how you can look really bad really fast, especially if you're an active manager of some form.
So there's two other benefits to these, which is the perception benefit and the behavioral benefit. So the perception benefit is kind of what we've been talking about, which is if I'm a value manager and I'm building a portfolio of value stocks, like I might have a lot of stuff my investors are looking at that are like, these companies look horrific. Like these things are just purely awful. You add quality to that from a perception standpoint, people are happier with the portfolio they see. And it's interesting. I don't know if you listened to this yet, but Gavin Baker was on Patrick O'Shaughnessy's podcast.
I have that
recently.
That looked really good. I love Gavin Baker.
Yeah. And a lot of it was about nothing to do with this. A lot of it was about just like his level, his knowledge of AI and like how everything works behind the scenes and how we're going to figure out who the winners are is like crazy. It's such a good podcast. But at the end, he mentioned something like in passing that I thought was really interesting. And I'd like to get your take on it because I've been thinking about it since I heard it. Like he was saying one of the reasons that, value one of the things that changed a lot with value when you brought all these quantitative funds in is like this idea that I'm pained to hold this company kind of went away. So like if I have an active manager, if I'm managing money myself and I put these stocks in my portfolio and I just look at this horrible company after horrible company after horrible company, I hate that. But you bury it in a value ETF and like now I'm okay with it. Now I don't really care anymore about it. And like, has that negatively impacted the performance of the value factor over time that like the pain to hold these stocks isn't there anymore? I thought it was a really interesting thing. And his conclusion, by the way, was that he thinks that over time now, like coupling AI with active discretionary value managers could lead to like a renaissance for those types of people because they're going to be able to like couple what they're doing with the benefits of AI, But I just thought that idea was interesting. I never thought about the idea that maybe some of these quantitative funds make it less painful to hold these value stocks.
Yeah, that is a really interesting way to put it. It's also fascinating because this all, to me, a lot of this turns back into a flow conversation. And I mean flow in the sense of somebody would have to come up with that, the comfort to hold the pain or put it in a way where the shareholders are excited about this or the opportunity that it creates. And then there has to be enough flows to move the needle on this thing. It's interesting when you think about the people who, again, like built up what we think of as, it's worth saying it out loud. 40 years ago, you were not doing this on a computer. You're at the library with a slide rule, ordering the annual reports from the SEC and doing all this stuff by hand. And there was a potential advantage, the Aswath-Damodaran thing of you can't just take something off the table. You got to bring something to the table if you want to take something away. 40 years ago, you had to do a bunch of manual work, and maybe you could see something via quality, via value, via whatever else that somebody else couldn't understand. The computers kind of started to take that away, where people were seeing the same things in the same way. That's accelerated to the point where, does the stuff even work anymore? Because the computers all know it, and therefore nobody's really looking at it anymore. If you could figure out a way to not just look at it, but get enough other people looking at it that it's creating opportunities again, yeah, it could be a little bit of a renaissance. I think I'm skeptical on what would actually get people to care again in a meaningful way. And maybe that's where we need like a market cap weighted ETF portfolio or some individual stock situation, or we need one of these like catastrophic events to go, oh my God, what did we build? And now who got it right? And how are they going to champion this mode of thinking for a whole new generation of investors? That's
I think about this a lot, and I certainly don't have any conclusions to any of this, but I always, like Gavin's argument was one I hadn't heard, and I've heard so many different arguments about so many different things. And I was thinking about it, and I'm like, you know what? It is very true that most quant managers like me don't even know what's in our value portfolios. Most investors who invest in our portfolios or invest in an ETF that's a value portfolio don't even know what's in there. So like maybe to some degree you have taken the pain, and also where the academic research has led to a lot of people being believers in like this overall factor that's powering the portfolio. And people are really thinking more about that than they're thinking about what they actually hold. So maybe some of the pain of holding, now again, the pain has still been horrific because these value portfolios have not been working. Like these ETFs that are out there have underperformed. So it's not getting rid of the pain, but it's interesting because it is getting rid of a little bit of the, like looking at this individual company and being like, that thing's a catastrophe. Amazon is destroying that company. Why do I own it? And Google's destroying this company. Why do I own it? And, that part has sort of gone away because there's this disconnect between the person and what's actually in the portfolio.
Yeah, absolutely. It's another one of those questions where it comes back to what's the actual purpose of, capital markets? It makes you really start to question things all the way down to the most foundational and fundamental level. It's worth asking, though. It's worth thinking about. And it's worth asking what would trigger people who are comfortably bearing that pain, either in the name of the company itself or the statistical reality that that company currently occupies, that would all of a sudden bring a bunch of attention back into this mode of thinking. And I don't think this mode of thinking has just left us and doesn't matter at all again, ever. I think it's just what's going to be the triggering event that makes people care about these things again, if and when that occurs.
Yeah. And there's so many different moving parts to this. I mean, we've talked to Mike Green on the podcast, like his work plays in here. We've talked to Ben Hunt on narrative driving markets more than fundamentals. That plays in here. There's so many moving parts to all of this that it's impossible for any of us to figure it out. But, one of the things we try to do with the podcast is present as many different cases on different sides of this as we can, so that we can sort of think this through to the future. I guess we've got a little bit of a tangent here from quality and low volatility. So I'll bring us back, but it is an interesting discussion to have. And the last point I'll make on quality and low volatility is they definitely are similar in many ways. So you would expect to some degree, like a quality company to exhibit lower volatility than the market. It's not like value. I mean, value has significantly higher volatility than the market. You'd expect like these things they're not the same. They definitely have added value to each other, but there are some similarities between the types of companies that would have all these things we defined as quality, but also might be lower in the volatility spectrum.
It's interesting because it just goes back to just pick boring stuff. Like boring is wonderful in a story-laden, distracting, all over the place thing like public markets in particular. Boring has a place, and whether that's quality and low volatility, however you define it, however you pair it, if you figure out a way that boring in the right direction can work in your favor, it can be pretty friggin' useful.
So we're going to get into some ETFs here to kind of look how this works in the real world. But one thing I forgot to mention earlier that I want to mention before we do that, because we're going to look at two different types of ETFs, is there is a difference between low volatility and minimum volatility. And you'll typically see that in ETFs names, and we're going to look at two of the bigger ones as we go through here. But low volatility is really focusing on the individual assets. So I referred before to standard deviation and beta. Like if I'm building a low volatility portfolio, typically what I'm doing is finding low beta or low standard deviation stocks. I'm adding them to a portfolio. I'm not thinking in a portfolio context. I'm thinking add the assets that are lower volatility. When I operate with minimum volatility, what I'm really focusing on, I'm maximizing on, is the volatility of the overall portfolio. And what I might do in that case is I might add things that might score higher on individual volatility because they reduce the volatility of the overall portfolio. So for your average investor, there's probably not such a huge difference that they have to be that worried about this. But important to see this because you will see, and they typically will say it in the name. You'll see low volatility ETFs, you'll see minimum volatility ETFs, and they just are a little bit different in practice. So I think it's important to acknowledge that.
Understanding, and I know we're going to look at some individual ETFs just for examples of this can impact all sorts of other constraints, because this is where you start to have the questions of if it's low vol and it's low volatility and therefore focused on security selection, having these low volatility tendencies, this is where you want to be aware of sector exposure. This is where you want to be aware of sector constraints. This is where you want to ask questions about what the rebalancing cadence is, because we've seen on more than one occasion these low vol funds basically turn into giant sector bets or whatever else because a specific sector or part of the markets has become very low vol, and then it's become pervasive to this group of stocks that all exhibit similar characteristics, and that can be an issue. And then conversely, when we get into like min vol and we start to think about it in the portfolio context, same thing, sector constraints, turnover, the way this is constructed at the portfolio level, because both can paint themselves into corners. And you just want to understand when that methodology starts to paint itself into a corner, especially in the context of an individual's broader portfolio. Great useful tools, but you got to still look beyond just the title too, which is why we're going to dive into a few of these things now, I think.
Yeah, that's a really important point. Again, we're going to look at this in 1 second, but that's the idea is you've got to think about, all right, I'm investing in a low volatility ETF. All right, what are all the other things going on beneath the surface that I need to understand as to what it's doing? Because to your point on sectors, I mean, low volatility tends to focus in certain sectors. If I'm investing in a low volatility portfolio, I may be overweight a bunch of sectors relative to other sectors. And that may have implications on the rest of my portfolio and how I'm thinking about it, because I may not want to have as significant a weight in those sectors in the other part of my portfolio because I may be concerned about the overweighting on the low volatility one. But then there's other of these funds, and we'll look at this in a second, that'll say, like if I'm a quality fund, I could say I'm going to be sector neutral. And I could say, all right, I'm not going to deviate too much from the sector allocation of the S&P 500. So in that case, the natural tendency of the factor to concentrate in certain sectors doesn't really matter to me because the ETF is handling that at the ETF level. So we'll dig into it now, but that's the type of stuff you want to look at. And we have a tool in Validea, which we're going to look at right now, but there's a lot of tools out there. Ours is free. But you can just use these tools to figure out when I'm buying, I want quality as part of my portfolio. I want to invest in quality. Well, how do I get there? I mean, I can use, like we mentioned QVAL before, I could buy a value ETF that has some quality exposure in it. I could invest directly in quality and not care about valuation. I could invest in something that has, 200 holdings. I could invest in a focused portfolio of 30 stocks. I could invest in something that's sector neutral that's not sector neutral. There's so many different ways this can be done. And it's hard for an investor. Like if you go read the prospectus, a lot of times you still have no idea what they're doing. So what these tools do for you is they allow you to say, all right, what am I actually getting here under the hood in this portfolio? And the way we do it is we actually look at the current holdings of the portfolio. So we're looking at what they hold right now, and we're telling you, how does that portfolio rank using a variety of metrics here. This is an example of what I was talking about. This is the iShares US Quality Factor ETF, which is a very big, $46 billion is the amount of money I'd love to manage sometime in my career, but obviously a very big, low cost, quality ETF. And going down to here, this is the kind of stuff we were talking about before. So this is what you'd expect it to be. Their exposure to quality is very, very high. Now, like we said before, there's different ways to define quality. Like in our Validea composite for quality, we have ROE, return on capital, gross margin, net margin, EPS consistency, and sales consistency. And it looks like, they may be using some of these more than others. They probably are not that concerned with gross margin because that score is pretty low, but they definitely seem concerned on the return on equity, return on capital, and the consistency type metrics. But you're getting what you'd expect to be getting here, which is you're getting a high quality portfolio. So that's kind of question one when I'm looking at any ETF. It's a quality ETF. Am I actually getting a quality portfolio? And here I am. And then it's always interesting to look at like what the other exposures are. So for instance, I mentioned before that quality and low volatility have a lot of similarities. So you'd expect like above average low volatility scores. That's what you're getting. It turns out right now there's a lot of momentum. That's probably not a function of they're using momentum in their criteria. It's probably a function that these quality companies have been doing very well relative to the market right now. So they happen to have a lot of momentum in their portfolio, although they're not trying to have the momentum in their portfolio. And right now, these companies are not particularly cheap. So right now you have lower exposure to value, but it's important to keep in mind, I mean, quality, low volatility, these factors can fluctuate with respect to their exposure to the other factors. So there's times where quality stocks can be cheaper. I mean, you'd never expect to see 99 on value and 99 on quality, because why would the most quality stocks in the universe be the cheapest stocks in the universe? That would never happen. But you can have different exposures to value. So right now, what you'd expect is here, which is these companies should not be particularly cheap if they're the actually highest quality companies in the market. So you're seeing here in this ETF what you would expect to see in an ETF like this. And the other thing I just want to, before we switch to another one, and I get your take on it, is like looking at this sector exposure you mentioned before is always interesting. And what you're seeing here is very, very little deviation from the S&P 500. And so what that tells me is what I said before is probably true here. I mean, I haven't read the prospectus, but they have some sort of system in here where they're not deviating too much from the market in terms of how they're constructing this, because none of these exposures are all that different than what the exposure of the S&P 500 is.
So what's really useful about something like this, and just some real world kind of use cases for a strategy like this, I've definitely sat on investment committees or in pension meetings or other things where we're looking at stuff. And if there's an overall concern with valuations in the broader markets, people might start to say, well, we don't just want to be out of the market for valuation concerns, but we are concerned about what's coming next. Let's increase the exposure to quality because of where we feel we are in some macroeconomic cycle. Something like this might be useful in that situation because you go, I'm still getting my sector-based exposure right. I'm not filtering out because of value so aggressively that I've turned into a value fund, but I've kept that sector exposure. I still have my large cap stock exposure. And now what I'm doing is, if I'm worried about economic sensitivities, I'm kind of minimizing some of the stuff that might be more sensitive to whatever bad happens next. Spoiler, the risk of that is these measurements are looking in the rearview mirror, and what else loves to happen than a good curveball to the teeth of some of these companies. So you got to be aware on both angles. But that's one good argument for saying, if I want to control for sectors, if I don't want to be overly concerned with valuation, but I really want to boost the quality, a fund like this can help meet all that criteria effectively.
Let's just look, we weren't going to look at a value ETF, but I just to describe what we were talking about. So this is another example. So this is QVAL. This is the Alpha Architect Quantitative Value ETF. And if I was correcting what I said earlier, like this is going to be a value ETF with significant exposure to quality. And then that's what you're seeing. I mean, typically and you could tell which metrics they're probably using or similar metrics they're using, but typically with a value ETF with, 97 exposure to value, you're going to see very, very low quality. If you just do it by default and your only criteria are the value criteria, you're going to see very, very low exposure to quality. But what they've been able to do here is they found a pretty an above average quality portfolio while still getting in the 97th percentile in terms of cheapness. So that's really, really interesting. Like that's very, very hard to do. And there's sometimes you can do that in the market and there's sometimes you can't. But this is an example of a value ETF that's using quality. And so using this tool or a tool like it, this would tell me, all right, they're starting with value here clearly because that's the highest thing, that's their highest rankings, but they clearly are focused on quality. And I could pull up some other value ETFs where these quality scores would just be at the bottom, where you could say, all right, clearly here, they're just focused on value. They don't care about quality. So that's how these kind of tools can help you as you analyze different things.
And back to, say you're sitting on an investment committee, your argument is you think the markets and the economy is about to go into some type of savage downturn. And if you just scroll back down to go down to the sector exposure on this one, if you want value to take your priority, then, well, what's going to happen? You're going to be way underweight technology stocks right now. And that's going to really impact your exposure going forward. That dramatic overweight that you see here to energy is going to show up in lots of places. It's a great way to take overvaluation risk down in a portfolio. And I'm thinking of it as like a subcomponent of a portfolio here, but it comes with the added risk that you're very deliberately now making a value bet, not just the quality bet.
Yeah, this plays into, we've had Wes Gray a bunch of times on the podcast, and, Wes is a big believer that on a long only basis, you don't want to do sector neutral value. You want to let value go wherever it finds it. And that's what you're seeing in his actual portfolios. He's doing that. He's heavily underweight technology, which, by the way, is very, very expensive relative to all these sectors. So this shows, you can see when you see somebody talking about their portfolio, or you see what it says in the prospectus, you can use these types of tools to really figure out what's in the actual portfolio. What are they actually doing? And in the case of this, they're doing exactly what they said they're doing. And the ETF we talked about before too. So that's good. I mean, you're seeing what they're doing, and then you're seeing kind of what the side effects are. Well, how does, if I have a completely high quality portfolio, what are the side effects with respect to the other factors? It's just interesting to see all that. So what we'll do, go ahead.
It gives you context. So the nice thing about seeing this is you can start to go from, what are we actually talking about? What are we trying to accomplish? And then, does this fund help accomplish this? Again, not in isolation, in the context of the broader portfolio. This is still one piece of the pie. It's not necessarily the whole pie. Tools like this are how we start to understand how this one piece might fit in and influence the rest of the pie. You don't want to take your pizza pie and jam it into your blueberry pie without thinking about what those consequences are.
That would just be disgusting, would be the consequence of that, I would assume.
Well, I didn't say orange juice in pizza.
So let's look at this one too. So this is SPHQ. This is just another quality ETF. And again, we can get, it looks like a very, very similar definition of quality, I would guess. Again, I haven't read the prospectus, but like the scores end up very, very similar to what we're seeing before. We still end up with a low level of value. We still end up with an above average exposure to low volatility. So you're seeing very, very similar things here. One of the differences here is clearly there's a little bit more of an ability in terms of how they're constructing the portfolio. I don't know. The other one might have been market cap weighted. I'm not really sure, but like you're seeing more willingness to deviate from the benchmark in terms of, you're not seeing what you saw with QVAL, which is significant, changes in the exposure to the sectors, but you are seeing changes here. So that's something, again, you'd want to know. This one is a little bit more in terms of its willingness to deviate from the benchmark with respect to the sectors. So I just have to understand that as I'm building the portfolio. And I understand that these sector exposures, these over and underweights may change over time. If certain sectors end up being higher or lower quality, although again, they're pretty consistent. I mean, you're not going to see utilities and energy, you're typically not going to see in the high quality bucket. These days you're seeing technology more and more in the high quality bucket because those big technology names are actually very high quality companies. Whereas back in the day, you wouldn't see that. And way back in the day, you actually would see energy, in the high quality bucket sometimes. And you would see it in the low volatility bucket sometimes as well, but that's not the case anymore. So it's just interesting. It gives you an overall look at what all this stuff is. So yeah, I think let's just look quick at low volatility as well. Just a couple of these. Let's look at SPLV. So we're going to look at a low volatility ETF, and then we're going to look at a min volatility ETF. Let's look at that. This is SPLV. So this is SPLV, which is a low volatility ETF. And we can see, are they doing what they're supposed to be doing? Yes, they are. Low volatility using either, I don't know what metric they use, but maybe it's standard deviation. I don't know, but what I do know is that they're pretty correlated with each other, and that overall you've got a very low volatility portfolio. Again, as I mentioned before, typically if you have a low volatility portfolio, you're going to have above average quality. So we see the same thing we saw with the quality ETFs, just in reverse. Now we're seeing the highest scores on low volatility, but still above average scores on quality. Whereas before we saw the highest scores on quality and the above average scores on low volatility. And again, this is, with value, low volatility is kind of like momentum in that it's a chameleon. Depending on how these stocks are being priced by the market, they can be very cheap. They can be expensive. You just don't know. They can have momentum. They cannot have momentum. So that can change a lot over time. That's more a function of like how much the market is appreciating these types of companies at any given time. And then Also, you'll see here what you would expect. People typically with low volatility think about consumer non-cyclical. Those are your staples. Utilities typically fall in this bucket. Technology, you might see more of that in the future, but right now, in general, below average exposure to technology. So I'm kind of seeing what I think I would want to see in a low volatility ETF.
You map it back to how much additional active share do I want to take on? How much additional tracking error do I want to take on? And that can be as simple as because I'm trying to make a very deliberate or specific market call or a positioning overweight or underweight. And it can be as specific as just, I believe in this thing. I think it's going to work over time. And here are all the reasons why. This is one of the ones in particular where it's really interesting to watch the chameleon definition, put the highlighter on that all day long, because you'll see that utilities and consumer non-cyclical overweight and that tech underweight, you'll see that shift over time. It'd be really interesting to go back to the last rebalance date on this one and just see where those things were, because it feels like tech was probably a lot more stable maybe 6 or 9 months ago than it's been in the last few months. And I wonder how that's impacted the way that sector exposure, for example, looks today.
Yeah, the sector exposures will usually be pretty consistent with low volatility, but to your point, they certainly can fluctuate. You're typically those sectors that are at the absolute top are usually there, but over time you will see them fluctuate, and also over very long periods of time. As I mentioned before, you'll definitely see them fluctuate. Like we had somebody, I forget who it was, but we were interviewing somebody about low volatility in the podcast, and they were talking about what I said before, how like way back in the day, like energy could actually be a big part of these low volatility portfolios. And like now it's basically not ever a big part of these low volatility portfolios. So it does fluctuate over time, and it's interesting to keep track of it. And just before we wrap up here, I just want to do one more. Actually, I've got the wrong box there. So before we wrap up, I just do one more. I want to do I want to do minimum volatility just to show that is a different construction technique. So USMV minimum volatility ETF, you'll see we'll go down to low volatility. You'll again see high scores because, like we said before, these are very similar to each other. They're similar approaches. You wouldn't expect to be running a min volatility strategy and then have like all the stocks not be low volatility that's in there. That makes no sense. So you're seeing something very similar here. You're seeing very high scores on low volatility, maybe a little bit lower scores because, again, my primary thing here is not the scores of the individual stocks. My primary thing is the overall portfolio. You're seeing high quality. You're seeing a little bit below average exposure to value. You're seeing the same types of stuff you saw in the other thing. So I'm seeing what I would expect from a min vol portfolio, and I'm seeing some willingness to deviate from the benchmark here again. I think a little bit less than maybe what we saw in the other one, but again, similar, but overweight here to healthcare more so than the other ones. But beyond that, the staples again, the utilities again, the underweight to technology, the underweight to energy. I'm seeing a lot of the same things I saw with the other one.
Again, think about this in portfolio construction language, where if this is the piece of the pie that you're looking at either adding or amending or whatever else, you're asking these questions about how does this act in complement to other things that I'm doing? It's kind of simple to see, depending on what your current exposure is, how layering this on top of another piece of your public market exposure, especially your large cap exposure, how this would sort of like influence who you're exposed to. It's also really interesting, not to keep bringing up the sector thing, but I just think it's one of the most interesting places this plays out. This gives you a little bit more utilities, but not a ton more utilities. And this gives you more of like your healthcare, your consumer non-cyclicals, some of the other things. You have the tech underweight, but it's not quite as dramatic here. So for somebody who was concerned about valuation and a downturn in the economy, for example, this might be an interesting way to pare back on maybe like a US large cap passive equity portfolio.
And what you're seeing here, which is interesting, is, when you're not just focusing on the low volatility assets, but back to your point about the sectors, you can end up with a little bit more of a diversified sector exposure. Because if you think about it, if portfolio volatility is my primary goal, then I'm probably going to have a little bit more. My strategy or however I calculate it is probably going to end up with a little more diversification across the sectors, because bringing in that sector diversification is going to reduce the overall portfolio volatility. Whereas when I'm thinking about it on an individual asset level, I'm just bringing in the assets that are low volatility, and I can tend to have maybe a little bit more overweight in certain sectors because that's where those assets reside.
And that's going to show up in a lower active share. That's going to show up in a lower contribution to your tracking error. And hey, at 15 basis points, if you're trying to express a view like this in a almost $24 billion fund, There are ways to use these tools that are very effective for an investment committee or somebody else who's thinking about this stuff. You have a view, you want to express it. There's tools to help think through, like, okay, stocks have had a great run. We want to take a little off the top without taking away the exposure. Maybe a quality tilt or something like that can help you in feeling good that you've made some step towards achieving that result. It's not an encouragement to go out and do those things, but there are ways to sin a little, to borrow that term, with tools like this.
Yeah, what you said plays into the last point I wanted to make. And I would like to highlight the work of Pneumatic Samuel when we can, because his site, pictureperfectportfolios.com, is excellent. He does a lot of great work there. And what he's really trying to do on that site is he's trying to build multi-asset portfolios that have great like volatility, drawdown, risk and return characteristics. So he's looking a lot about how can I build these really low volatility portfolios that combine assets together and have very minimal drawdowns relative to, say, like what a stock and bond portfolio would do. And the reason I bring that up is both of these factors, and particularly min volatility, are really good from that perspective. Because if you think about it, if I'm building a portfolio that has stocks and has a bunch of other assets, and I want to have the minimum volatility possible, well, I can deal with the volatility by having all those other asset classes in there, but I also can deal with volatility within the stocks bucket. And that's what he's doing when he builds these portfolios. He'll use a lot of these. I think he uses USMV a lot, the min volatility ETF. That's a great use of that, because not only are you reducing the drawdowns by bringing in the other asset classes, but you're reducing the drawdowns with the lower volatility. And to our point at the beginning, like there's a lot of data to suggest that I'm not reducing my return when I'm investing in these low volatility type stocks. So if I can get a similar return for my stocks portfolio with less volatility, it's perfect for these types of multi-asset drawdown managed types portfolios.
One of the great things about just all these products existing in the world now is that different people, and we see this with clients, like SunPoint has our firm models that we run, and then the sub variations of those models. But when you're trying to build that portfolio to meet goals, objectives, and the behaviors of the clients across the table, being aware of tools like this, being aware of the research and the work of people like Pneumatic Samuel and putting all this together, it can be really effective to say, we have the tools to build the investment part to overlay with the plan that you're on to make you feel better about this. Minimum vol, low vol can be very effective in distributing portfolios, for example, and we've done a lot of work on this. It can be very effective to pair with income generating portfolios. Again, when somebody is in a distribution phase for all of or a tranche of their assets, they can be very effective, because in those cases, like we've talked about with the 4% rule and other things, you're just trying to avoid the big drawdowns where you're taking out a fixed percentage or a fixed dollar amount of that pie. And so if I can reduce the amount of the size of that drawdown, the sustainability of things like withdrawal rates actually goes like a really, really, really long way. So these products existing out in the world as tools, huge value add. I love that you guys have the tool too, where we can quickly skate through some of the high level details to just tighten up the conversation.
And just to wrap up with a final point, like behavior is everything in investing. And that's something we've talked about a million times in this podcast. And that's where these factors are really, really good, because anything that's reducing the volatility of your portfolio, anything that's making you feel more comfortable about your holdings because they're higher quality companies, if it makes you more likely to stick with your investment strategy, these can be more valuable factors than even, say, value and momentum. Because although I might say value and momentum are your A-level factors and these are your B-level factors, for some investors, these are your A-level factors, because they believe in them. They reduce the volatility of your portfolio. They allow you to stick with your strategy. Like that's everything in investing. So I think that's probably, to me, the biggest takeaway from these factors is that they can be a great addition to a lot of people's portfolios because of those characteristics they have.
They give us a language to describe them. And if my name isn't Matt Minval Ziegler and you're not Jack High Quality Forehand,
I wish it was. It would be a great name for me, but it's probably not. It's probably not what I am.
It would really affect the sign off for this episode if we had those names, but unfortunately we don't.
It would.
But we do have these tools.
If we start signing off based on that, some people got to check our egos somewhere. We probably need to get off the camera and go do something else. But anyway, on that note, thank you everybody for joining us, and we'll see you next time.
Hi guys, this is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbonneau, and follow Matt on Twitter at CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.
Jack Forehand is a principal at Validea Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital or Sunpoint Investments.